Hey everyone, welcome back to Corporate Decoder. Today Edit just filed an update on a major public offering, and I am seeing a key detail that could impact future stock performance. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is raising a significant amount of cash, but the terms of their new warrants might hold a surprise for investors. Editas Medicine Incorporated, a company focused on biotechnology, has just announced the details of a big public offering. Essentially, they are selling a lot of their stock to the public. This is a common way for companies to raise money to fund their operations, research, and development. This filing tells us that on May 26th of 2026, Editas signed an underwriting agreement. Think of an underwriter as a middleman, usually an investment bank, that helps a company sell its securities to the public. In this case, Cantor Fitzgerald and Company and Wells Fargo Securities LLC were the underwriters. They agreed to help Editas sell shares of their common stock. They are offering a massive number of shares here, over 55 million. This is a pretty significant amount, which means a lot of new shares are being added to the market. When this happens, it can sometimes dilute the value of existing shares, meaning each share might represent a smaller piece of the company. Here is where it gets interesting. They aren't just selling shares of stock. Each share being sold comes bundled with a stock warrant. A warrant is like an option giving the holder the right to buy more stock at a specific price in the future. The initial price for this bundle 1 share plus 1 warrant is set at $2.25. The underwriters are buying these bundles from Editas at a slightly lower price, $2.115 per bundle. This difference, $0.135 per bundle, is essentially the underwriting discount or fee. It is how the underwriters make their money. So after all the fees and expenses are paid, Editas is expecting to bring in about $117 million from this offering. That is a substantial amount of cash. Now, let's talk about those warrants. If all the warrant holders decide to exercise their right to buy more stock, Editas could get an additional $192.5 million. This is a big if, of course, as it depends on the stock price and other factors. These warrants have an exercise price of $3.5. This means that if the stock price goes significantly above $3.5, people holding these warrants will likely want to use them to buy shares at that lower price. Here is the unique and potentially critical part of these warrants. They don't just expire after a set period like 3 years. They can also expire much sooner in just 30 days. If the company announces positive phase 1 clinical data for their product candidate called EDIT-401, specifically showing a significant reduction in LDL cholesterol in patients. This is a really interesting incentive structure, linking the warrant expiration to a major scientific milestone. These warrants also have ownership limitations. A holder cannot use the warrants if it would cause them to own more than 4.99% or 9.99% of the company's stock. This is a standard provision to prevent a single investor from gaining too much control through warrant exercises. The filing also mentions what happens in case of a fundamental transaction. This is a broad term that includes things like the company being bought out, merging with another company, or selling off most of its assets in such a scenario. Warrant holders would have the right to receive whatever they would have gotten if they had exercised their warrants just before the transaction happened. This protects their potential gains. The underwriting agreement itself, like most of these deals, includes standard clauses. These cover things like promises made by the company, conditions that need to be met for the deal to close, and who is responsible for what if something goes wrong, especially concerning laws about selling securities. Moving on to another section, there is information about other events. This often includes press releases that announce key developments. Here, they are filing the actual press release that announced the pricing of this offering. This is usually where you get the most direct communication from the company about the deal. Now, let's look at something really important for investors, cash runway. This is how long the company can operate with the money it has. Editas believes that with the money they are raising from this offering, plus the cash they already had as of the 31st of March, 2026, they can keep their operations going all the way into the second half of 2028. That is a pretty good runway, nearly 2.5 years. This suggests they have a clear plan for how they want to spend this capital. This part of the filing is the standard disclaimer about forward-looking statements. Companies use this to protect themselves legally. They are basically saying that statements about the future are just that, predictions and actual results could be different due to various risks. They list common words that signal a statement is a look into the future, like expect, plan, or predict. It is a heads up that what follows might not necessarily happen. They are warning that real-world events could be very different from what they are predicting. This could be due to market turbulence, issues with closing the offering, or simply not having enough money to cover all their expenses long term. It is a reminder to be cautious about future projections. Finally, we have the section on exhibits. This is where they list all the supporting documents that are filed along with this report. This lists the actual underwriting agreement we talked about earlier, the core document for this offering. And here is the form of the common stock warrant itself, including the pre-funded warrant. This is where the specific details of those warrants, like the expiration trigger and exercise price, are laid out in full legal terms. And the press release that kicked all of this off. So what is the story here? Editas Medicine is doing a major stock offering, raising a significant amount of capital. They are getting about $117 million up front and could get another $192 million if the warrants are exercised. The cash runway has been extended into late 2028, which is a positive sign for their operational stability. However, the most interesting part is how these warrants could expire quickly if they announce positive clinical data for EDIT -401. This creates an unusual dynamic where positive news could actually be a trigger for the warrants to expire, potentially limiting upside for some investors if not timed right. The key takeaway for me is that while this offering provides much needed funding, the market will be closely watching for signs of that clinical data. If it comes, it could complicate the warrant situation, but signal a major step forward for the company's drug development. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.